Let's take a look at Chapter 3. You can see the title here is called Financial Statements, Cash Flows, and Taxes. So we'll take a look at the financial statements that companies produce. We'll talk a little bit about free cash flow, what they call EVA and MVA, which is economic value added and market value added, and a little bit about the tax system. So the annual report of a company is where you will find the financial statements: balance sheet, income statement, statement of cash flows, and statement of equity. And this kind of just describes a little bit about what each one shows the user of the financials. So just make sure you understand that. And then the PowerPoint gives us an example of a company called DeLeon, snack food manufacturing company. They went through a major expansion, and unfortunately the expansion has not turned out well. Their cash position is weak, suppliers are paid late, and the bank has threatened to cut off credit. Just think of them as like Little Debbie. Just imagine if we were looking at the financials of Little Debbie. It's kind of the same thing. And what's good about the PowerPoints is they give us examples that are very simplified and straightforward, very easy to understand. So once you feel like you've got a handle on the examples in the PowerPoint, then I would tell you to go back and look at the book, look at what's in the chapter. And they give you a different example that's more detailed, has more information, and obviously therefore a little bit more difficult to understand. So it's always good to kind of make sure, okay, I think I understand the PowerPoint one, then go back and take a look at the book, and that's a good way to start. So they're going to show us financial statements for the 2 years. 2018 was before the expansion. 2019 is the first year after the expansion went into effect. So this is the balance sheet and the asset side of the balance sheet. You can see their cash position went down dramatically. Account receivable went up a lot. Inventory went up a lot. FA stands for fixed assets, so that went up quite a bit because they expanded. They invested in property, plant, and equipment. Because we have more fixed assets, therefore we have more depreciation. And total assets came close to doubling, because of the investment in property, plant, and equipment, but also because receivables go up and inventory goes up. On the liability and equity side, we can see some other things here. We can see that accounts payable goes up dramatically. Accruals goes up. Look at notes payable. It goes up from 200 to 636, an increase of 436,808. And then long-term debt goes up by $400,000 exactly. So between notes payable and long-term debt, that's a little bit more than an $800,000 increase in debt. Common stock did not change, and that tells us that they did not issue stock to fund the expansion, and retained earnings goes down. If you can recall from an accounting class, think about what makes retained earnings go up or down. Net income makes retained earnings go up, and net losses make that go down. So you can see a significant drop here, which should be a clue that we'll have a net loss for the year. So let's take a look at the income statement. Our sales is a positive, and then basically what you have to do from here is take a look at the operating costs excluding depreciation and amortization. The 6047 and the 3222 is the sum of the expenses. So my expenses in 2018, cost of goods sold and other, was 3222672, and then my 2019 cost of goods sold and other was 6047988. So the good news is sales goes up a lot. Okay, 3432 to 6126, roughly a $2.7 million increase in revenues, and that's good. However, there's always a however, it seems like. The downside is that my total expenses went up a little bit more than that. So I didn't necessarily really get ahead. So I expanded, I have more sales, but my cost of goods sold and other expenses went up at a proportion slightly above that. So after I factor in depreciation and amortization, remember I have more depreciation because I have more property, plant, and equipment. I end up with essentially a loss. And EBIT stands for earnings before interest and tax. It's kind of like operating income would be one way to call that. So it was a positive, and now it's a negative. And then, of course, because I have more debt, I have more interest expense. So my EBT, my earnings before tax, you can see now is a significant loss. And then I have a tax at 25%. And I have a loss here, so there's no necessarily any tax bill in 19 like there was in 2018. Okay, so other data about the company, the number of shares, as I mentioned, didn't change because they did not issue more shares of stock. Their earnings per share is basically their earnings divided by the number of shares outstanding. So that would be the 160, 176, and the 109,950 divided by 100,000 is these two numbers here. DPS is dividends per share. It was 27.5 cents and now it's 11 cents. They probably shouldn't have paid dividends at all in reality. The stock price went down significantly and lease payments is not changed at 40,000 per year. So let's take a look at their equity statement. So as we mentioned, the common stock didn't change. What did change is retained earnings. It went down for two things, the net loss and the dividends paid. So the net reduction was 171, 176. So equity went down significantly in total. And then we look at the cash flows. Cash flow statements are broken down into three categories: operating, investing, and financing. Cash flow from operations is kind of loosely what you would call a cash basis income statement. You take the net income number, which has GAAP accruals in it, non-cash expenses like depreciation, for example, and it backs those out to get down to a cash basis net income or net loss. Ideally, this is a positive. For companies to be successful, your cash flow from operations has to significantly be a positive number. Excuse me. And if it is not, that means you're losing money by doing what you do. If you're daily on, you are buying raw materials, sugar and flour and all the things that you need to make snack cakes. And then you make them, you package them, you sell them to stores, gas stations, whoever will sell them for you. And that's how you make money. And if you lose money by doing what you do on a daily basis, you can't do that forever. You have to have some positive years, right? So this year did not turn out well at all. So they had a net cash loss for operations of 164, 176. Investing relates to investments in property, plant, and equipment, and they significantly invested in property, plant, and equipment this year. They borrowed a lot of money. They turned around and spent that on expansion. On the financing side, they went out and borrowed money, notes payable, long-term debt, plus they also paid dividends. So that was a net increase to cash from borrowing of $825. And then their cash position, unfortunately, went down by $50,000. So unfortunately, the cash position went down quite a bit. So just some things here that they're going to summarize. I probably mentioned them. But the cash flow from operations negative. They borrowed $836,808, and even after the borrowing, their cash position still fell by $50,000. Okay, now a significant term that you'll need to know for the entire class, and not just chapter 3, but for the entire class, is the difference between net working capital and net operating working capital. It's a subtle difference, but it's one that will trip you up if you don't know it, because you'll be making some calculations using these two definitions, and if you don't get them right, your calculations are wrong, you get homework assignments wrong, and so on. So net working capital is a simple one. It's really just current asset minus current liability, nothing else. Net operating working capital is operating current assets minus operating current liabilities. Okay, so net operating working capital is, the big difference is notes payable. Okay, so basically operating current liabilities is everything except notes payable, except debt. So current asset minus current liabilities, net working capital, net operating working capital. I just back out notes payable, and I'm good. Okay, and it does mention also, I should mention also that it does say current assets minus excess cash. So any excess of cash that we may have, we would back out. And that's possible. Now, it's not De Leon's, it's a good problem to have, right, to have too much cash. It's not De Leon's problem. But sometimes companies that are very successful will have excess cash, and the question is, what do I do with that? Do I invest that? Whatever. But I don't necessarily need that to fund my current operations because I've got plenty of cash on hand. So cash above and beyond what we need to fund current operations. But it's important that you know the difference between those two. Okay, so for De Leon, did the expansion create additional after-tax operating income? Whoops, and I went too far there. And the answer is, well, actually, no. So after-tax operating income is my EBIT, 1 minus tax rate, and you can see that it was a negative, and then the tax rate is 25%, and so we get to a negative 28,614. Compared to what it was in 18, it was a positive 142. So it goes from a positive down to a negative, just like that. And then what was the effect on net operating working capital? You can see in 19, well, it was 905. It actually went up, and it went up primarily because we have the huge increase in receivables and inventory. So that's that current asset jump went up quite a bit. But that was really it. That's what contributed to it. That's not necessarily good. So it did go up. That doesn't mean it's a good thing though. And so let's take a look at the effect on operations. So while revenues went up, after-tax operating income declined, net operating working capital went up, and net income declined. Okay, and then the free cash flow. Now this is a formula that will show up frequently throughout the class. We'll have a future chapter where this will come up quite a bit. So make a note of this formula. This class is full of formulas. Probably a good idea to have a notebook or something where you might just jot some of these significant formulas down. You know, the capital ones that we just got done doing, the working capital, net operating working capital, jot those down, jot this one down, and just kind of have those near you when you go and do the homework. But the free cash flow will come up down the road too, as will the operating capital formulas. And it says here, it says EBIT, earnings before interest and tax, times 1 minus T. We add back depreciation and amortization because those are non-cash items, and we subtract from that my capital expenditures plus my change in net operating working capital. The triangle is the delta symbol, which means change. And what this formula is trying to do is figure out how much cash flow did my business generate. And the definition of free cash flow is cash that I could give back to investors as dividends without impeding my future operations. Okay. So it's cash available to give back to owners, which are the shareholders of my company. Keep in mind the reason we put in capital expenditures is even when a business does not undertake a significant expansion like De Leon did, every business every year has things that just need maintenance, things that need replacement, parking lots that need to get repaved, sidewalks that need to get repoured, carpet that needs to get replaced. There's always machinery that breaks down and needs to get replaced, or machinery that just kind of reaches the end of its useful life. So that capital expenditure number is at a minimum what we need to maintain capacity. But for like De Leon, it's that plus we're going to expand our production facility and be able to sell more, make more product. And the change in net operating working capital. So, and remember, when you expand, like De Leon did, that means I have to go out and acquire more raw materials, more ingredients to make the snack cakes. Therefore, I'll have more payables. If I sell more and I sell an account, I'll have more receivables and so on. So that's what they kind of mean by that. But that gets us down to a negative number. Now it says here, is negative cash flows always a bad sign? The answer is no. It can be an okay sign as long as we eventually get to positive cash flows, significantly, consistently get to positive cash flows. It is assumed at times when a company is rapidly expanding or undertaking some major expansion or renovation that you would have a year or two of negative cash flows. However, when that comes into play, you would have to also kind of think through at some point it has to go positive, right? So that's what you want to look at too. Okay, so next is performance measures for evaluating managers. and what they call MBA and EVA, and the chapter gives you very good examples and full explanations of both. And it says here that financial statements themselves are not enough to evaluate the performance of a manager. That's very true because financial statements are based on GAAP, generally accepted accounting principles. And the purpose of GAAP is to really meet the needs of investors and creditors, and not necessarily meet the needs of internal ownership, internal managers, and performance evaluations. So other methods should be used. So financial statements are a good starting point for sure to evaluate performance of a manager. That's okay as a starting point, but it should not be the sole measurement, because there's so many things in accounting that managers cannot directly influence. Maybe indirectly to some degree, but not directly. So MVA, market value added, is the difference between market value and book value of the firm's common equity. And P0 is the price of a stock today. So 0 just means today. And P is price times the number of shares minus book value. So that's the market value. You can look up market value for any company. Go to Yahoo Finance, type in the name of the company, and you'll get it. EVA is economic value added. And book value, got ahead of myself. Book value, let me say that right. Book value is what the equity is on the financial statements, on the balance sheet. That is book value. EVA is an estimate of a company's true economic profit. And the way you figure that out is you take the EBIT number after tax affected times 1 minus T. You subtract from that invested capital times the cost of capital. So that's the formula for that. So again, a couple more formulas here. Again, jot those down. Just make sure you have them with you as you do some of your homework for Chapter 3. And you can see here that they've given us what the MVA for 19 was. It's a negative. That's never good. And it was positive for 18. So that dramatically was reduced in the tunes of more over $400,000. So not good. And then the relationship between EVA and MVA. If EVA is positive, then after-tax operating income is greater than the cost of capital needed to produce that income, and that's good. Positive EVA on an annual basis helps to ensure that MVA is positive. So you need to have, basically think of it like this. If the return on my investment is greater than the cost of my investment, I have added value to the firm. And that's really what that is. Think of it like a company going to a bank to borrow money for the expansion. So let's just say we're De Leon. We go to the bank and we say, Mr. Banker, I want to expand my business. What's the interest rate that I will pay on a bank loan? Let's say the bank says, how about 5%? We agree on that. So basically then, if I take the money that I borrowed, invest that in my business, I have to earn a rate of greater than 5% to add value to my company, right? If I can get 8, 9, 10% return on that money that I borrowed, I will now have increased the value of my company. That's what EVA is trying to figure out for us. Did we earn more economically than our cost of the capital to make those earnings? Does De Leon pay suppliers on time? No. Look at how much AP went up, 260% over the past year. Sales increased by 78.5%. So, keep in mind, if your sales go up, and a company like De Leon is most likely selling on credit to its suppliers, grocery stores, gas stations, and so on, wherever you would find snack cakes, right? And they're shipping them to those stores with an invoice saying, pay me in 30 days. So it makes sense. If sales go up by 78.5%, my payables should also probably go up by that much too, because I'm making that, I have to buy that much more ingredients. So just kind of think of that cycle. So, that also means receivables should probably go up by that same number. And so my payables goes up way more than my sales, which means for sure I'm not paying my bills on time. And my suppliers at some point will stop selling to me, and they'll say, I'm not shipping you anything. And think of what we're buying, sugar, flour, things like that. I'm not shipping you a thing until you pay your bill. That's when we'll ship you more. So that's what we have to be concerned about as De Leon. So does it appear that their sales price exceeds the cost per unit sold? No, it's a negative after-tax operating income is really because they're spending more on operations. Their sales price is probably okay, but for whatever reason, their operations they did not become more efficient. Typically, when you expand and you begin to make more, the goal would be that you drive your cost per unit down, and they have not done that. So now that we know their situation, we can do what we call the what if game. What if we decided to do something different? So the sales manager, the person in charge of selling product to customers, and in this term, the customers would be grocery stores and gas stations. What if we decided to offer 60-day credit terms instead of 30 as a ways to generate more sales? Because if our competition doesn't do that, but we do, our customers may be more apt to buy more from us and less from our competition. So let's think about if we do that. Now, you might think that's counterintuitive. I'm short on cash. I can't pay my bills. Why in the world would I let people, spend 60 days to pay me back? Well, if I do that in the short term, obviously receivables would go way up, right? They would practically double. And my cash position would go down because I have to wait longer to get cash. So in the short run, that's what will happen. But let's just say that our competition says that's too crazy. We're not going to do that. We can't go to 60 days. Let them do it and figure it out. So let's just say our sales double. Okay. So in the short run, inventory and fixed assets will go up to meet the sales. Account receivable will go up and cash will go down. And we might have to find some bridge financing or something to get us through that time period until we hit that 60-day mark and the cash starts to come in. But in the long run, collection will increase and our cash position would improve. So it might be a short-term pain, but hopefully a long-term gain if that works out. It's hypothetical. How did they finance the expansion? I think we've already kind of proven that. It was all with long-term debt. We showed that. Would they have required external capital if they had broken even in 2019 and net income was zero? And the answer still is yes. The company would still have to finance the increase in assets. They had to find a way to pay for that net increase of assets of $711,950. So that was either borrowing or selling stock were the two main options that they have. It says, what if they immediately expense qualified business assets rather than depreciating them over a long period of time? Now, QBI, I shouldn't say QBI, the new tax law gives you some options when it comes to depreciation. So for certain qualified business assets, with some limits, you can expense them right away versus depreciating them over their useful life. So every business kind of has within limits some options, and by no means is this the business tax class, but that's basically what they're trying to get us to. That does not change your physical assets. It's just a matter of how quickly you depreciate them. But if they did that, if they immediately expensed what they could rather than depreciate them over time, well, the fixed assets in the balance sheet would decline more quickly because it's the cost minus depreciation taken. Net income would go down because we took a bigger depreciation amount, and that would decrease our cash, decrease the amount of money we pay for taxes, which means our cash position would improve. So the reason for doing that, while it's bad for the bottom line, that gives you a tax break, and so that saves on cash. And this company, when they're hurting for cash, that's kind of a big deal. Okay, so let's talk a little bit, very big picture about the federal tax system, both individual and corporate. Just so everybody knows, 2017, December of 2017, the most significant tax reform since 1986 was signed into law and went into effect for 2018. So it's fairly new. We really have only had about 1 year with it really being a thing. And both have a progressive tax structure, which is kind of the old way that it was. They both used to have a progressive structure, and the individual still does. On the corporation side, though, it's now a flat tax, and the percent's 21%. and also subject to a state tax around 5%. Now, obviously, every state might have a different corporate tax rate. Some states like South Dakota do not have a corporate tax rate, but most of the states surrounding South Dakota have something of a corporate tax rate. The old corporate tax law was the more you made as a corporation, the higher the tax rate, and now everybody just pays 21. Okay, so that's a big difference. And then business interest deduction limited to 30% of EBITDA. So the amount of interest that you can deduct has gone down a little bit too from the old tax law for corporations. Now for individuals, it was very significantly different. The old rates capped at about almost 40%, and now with the new law, the new highest rate's 37%. A lot of deductions were eliminated, and instead what they did is they gave everybody a higher standard deduction. It used to be about half of what it was. As you can see here, it's 12,000 single, 24,000 married. It used to be about half that. And to itemize your deductions, you know, the biggest itemized deductions most people have is if you own a home, that would be interest on your primary residence and property tax. And then in South Dakota, because we're a sales tax state, sales tax would be included. But if you're in a state that had a personal income tax, what you pay for that would also be a deduction. So, and then whatever you choose to give. So anything you give to church, to any qualified nonprofit would also go to your standard deductions. So with that going up as much as it did, fewer people are itemizing their standard deductions just because that number is so high now. But for individuals, begins at 10%, goes to 37%. For single individuals, incomes over 500,000, marries over 600,000. That's kind of where you get that 37%, which is the top bracket. So one big thing to kind of keep in mind when it comes to interest paid, the tax deduction for corporations is limited to 30% of operating income, but usually not for individuals. Now, the big difference between taxes for individuals versus corporations is for individuals, the only interest that we can use to reduce our tax bill is really only two, and primarily it's your home loan and some student loans. It's just there's always a lot of little rules with taxes. I think everybody knows that. But for your primary home, interest on that, and then some student loans, that's what you can deduct from your personal tax return. For a corporation, all interest is potentially deductible. So the corporation borrows to expand, borrows to buy a vehicle, borrows to buy machinery, has credit card interest, whatever it would be. It doesn't matter what the interest is. It's potentially deductible with limits of 30% of operating income. Okay, but it potentially would all be, just depending on how much interest you have versus your operating income. Okay, so that's one big difference between the two. Now, interest earned, let's say you have an investment and you receive interest income, and that's primarily bonds, and both individuals and corporations can be bond owners. That's taxable income that comes in unless you own what they call an muni, which is a municipal bond. And a municipal bond is a bond issued by some government entity, a school district, a city, a county, a state. And keep in mind why those governments issue those types of bonds. It's to pay for something, right? It's to pay for a new school, a convention center, a bridge, a road, something that benefits the public. And those governments need the ability to raise a large amount of money to fund those types of projects. And so investors were given an incentive to buy those types of bonds by basically saying, if you own those, interest you receive is never taxed. Okay, so interest earned is typically fully taxable unless it's a municipal bond. And then dividends paid for a corporation, keep in mind that a corporation itself is a taxable entity, and when that corporation pays dividends to its stockholders, they do that with after-tax income. And that means the stockholders, when they receive those dividends, pay tax on the dividends also. So corporations are double taxed. You pay tax on your earnings, you pay dividends, the person receiving the dividends also pays tax. Okay, so dividends received for most investors pay 15%. So that's actually a good deal. The nice thing about dividends received for individuals and for corporations both is what you pay. What you pay in tax is significantly different than what you pay in your ordinary income. So keep in mind, if you're a high wealth individual and your maximum tax rate is 37% for your normal income, the most tax you'll pay on dividends is 20%. Okay, so there's an incentive as a high wealth individual to own stocks and receive those dividend payments. There's really three, it says 0, 10, 15, and it's 20 is mentioned down here, but really there's 4 tax rates for dividends, 0, 10, 15, 20. It says here most investors will be at the 15% bracket. It's a pretty wide bracket, and the vast majority of taxpayers are going to fit into that. So let's just say your corporate income tax bracket for most of income is, let's say, 25 to 27%. Most middle class families would probably be in that 25 to 27% range. Well, if you own stocks, though, you're only going to pay 15% on the dividends. So there's an incentive to own these. And it kind of mentions what some of the brackets are here. Now, think about the corporation. I mentioned double taxation. Now imagine that you're a corporation that owns stocks, and that's very common. Most corporations take extra cash, they invest it, they'll buy stocks and stuff of other companies just as an investment. And so think about triple tax. So I'm a corporation, and I buy stock of another company, and that stock pays me a dividend. So I receive the dividend with after-tax dollars from the other corporation. That's dividend income for me that increases my net income. I pay tax on my net income. I pay a dividend to my shareholder who pays tax on the dividend. Okay, that's called triple tax. Now, that's good news is corporations get to avoid that, and they avoid that by having what they call a dividend received exclusion. So there's maximums and there's all kinds of rules around that. But a portion received of dividends by corporations who own stocks is basically excludable. And the max cap is around 70%. So if I receive $1 of dividends from another company, I only pay tax on 30 cents of that. 70% is excludable. I pay tax on 30 cents. So other tax issues for corporations, this might seem kind of odd, but they have what they call carry forwards and carry backs. And keep in mind, when you're a full-time employee of a company and you get your W-2 every year, barring some unusual big bump on your pay one year versus the next, most people get a cost of living increase, maybe 3 or 4%. Maybe you get a promotion one year, you go up 4 or 5%. Whatever that is, your W-2 is pretty predictable year over year over year. But for a corporation, you'd have good years, you'd have bad years, so your net income may fluctuate all over the place. And so the tax law says that you can do what they call carry forwards and carry backs, which kind of allows you to kind of flatten out your losses for tax purposes and offset profits in the future. So you can take a bad year and allocate some of those losses from your bad year to future good years to reduce your tax bill. And then capital gains. A capital gain is selling something for more than its book value, and then you have to pay tax on those, and it's usually 15%. And it's kind of the same. It's that 0, 10, 15, 20. So for a taxpayer, if you bought a stock, it's worth $10, and then you sell it, it's worth $100, and you had a $90 capital gain, most people would pay a 15% tax on that. But again, it's got the brackets of 0, 10, 15, or 20. If you make enough, you'll pay 20% tax on that. Okay, and that's it. So just a little bit about taxes towards the very end. Keep in mind for finance, we look at everything after tax. Cash is king in finance. Cash flows are very important. So we look at everything after tax, and that's why we talk a little bit about taxes in this chapter.